Investment outlook often depends on perspective. A pure optimist views today's environment as half glass full, focusing on resilient growth, easing policies, and improving earnings. A pessimist sees the half glass empty, highlighting elevated valuations, weak market breadth, currency depreciation, and global policy uncertainty. Our current assessment is more pragmatic. Half glass, more full than empty, reflects a realistic positioning, acknowledging visible risks and volatility, while recognizing that macro stability, policy support, and earnings recovery provide enough foundation to remain invested, though with tempered return expectations and disciplined execution. On the global front, US growth remains resilient with inflation staying above the Fed's 2% target. Despite this, a divided Federal Reserve cut rates by 25 bps in December, prioritizing rising unemployment, which is now approximately 4.4%, the highest since late 2021, over tariff-driven inflation risks. While the Fed took a more accommodative stance with QE resuming with bond buyback, the Japanese central bank has adopted a more hawkish stance towards yield curve control. Thus, rates have taken divergence paths in the US and Japan this year, with Japanese investors holding nearly $1.2 trillion in US treasuries and total yen-funded positions estimated at $4 trillion. Any sustained unwinding of the yen carry trade could hence pressure global equities and credit markets. India's macro fundamentals remain relatively robust. Q2 financial year 26 real GDP growth surprised positively at 8.2%, supported by manufacturing and services. However, nominal GDP growth slowed to 8.7%, due to a 24-quarter low GDP deflator resulting from broad-based price stagnation across commodities, metals, fertilizers, and agriculture. Decade-wise nominal growth analysis suggests that there is a structural shift towards single-digit nominal growth, reinforcing the need for more realistic earnings and return assumptions. The rupee has depreciated to record levels around INR 90 to 90.5 per USD, making it the worst-performing Asian currency this year. Importantly, this episode is materially different from past stress periods. The current account deficit is contained at approximately 1% of GDP, versus approximately 4.8% in 2013. CPI inflation has eased sharply to approximately 0.25% in October 2025, crude prices are in the USD 60 to 65 range, and foreign exchange reserves remain comfortable. This implies that the depreciation is largely flow and sentiment driven, led by FII equity outflows of approximately $28 billion since October 24 and ongoing tariff uncertainty, rather than macro fragility. RBI's RER indicates the rupee is 3 to 5% undervalued, and the steep INR depreciation should increase price competitiveness of exports, providing some cushion against the hit by tariff in the near term. Corporate earnings are showing early but meaningful signs of recovery. In Q2 financial year 26, Nifty's 500 sales grew 8% year-on-year and profit after tax rose 15%, with ex-BFSI profits up 20%. About 46% of Nifty 500 companies delivered profit after tax growth above 15%, and 17 of 20 sectors reported profit growth. Large caps returned to double-digit earnings growth, mid-caps sustained momentum, and small caps posted strong gains off a low base. The upgrade to downgrade ratio improved to 0.9, the strongest reading in 5 months. On the other hand, while Nifty is close to all-time highs, market breadth remains weak, with approximately 50% of NSE 500 stocks below 200 DMA, reflecting valuation fatigue and uneven participation, particularly in the broader market. Heavyweight sectors and stocks within the Nifty 50 index have provided support to it. Banks' margins, after witnessing muted NII growth and some NIM compression, are expected to stabilize and improve going forward through rate cuts, leading to repricing of liability side. Decent credit growth, along with low gross non-performing assets ratios, should contribute to the upside. The IT index is down by approximately 12% this year as valuations cooled off. Interestingly, IT services share in Nifty profits has been stable at 15% for the past 4 years, whereas its weight in the benchmark index is now at a decadal low of 10% versus a 19% peak in December 2021. We expect AI, cloud, and data spend to shift from pilots to implementation, leading to opportunities for IT companies. Moreover, lower attrition, better offshore mix, and a supportive currency may improve margins. In telecom, fresh tariff hikes expected in December 2025 to January 2026 could lead to better average revenue per user. These sectors make up more than 50% of the benchmark and are well positioned to provide support as well as lead the rally. The trailing valuations across the broader market have moderated compared to 1 year back, and froth has also subsided. We believe that the current phase is primarily a flow and valuation correction, not a collapse in fundamentals. The temperature gauge index remains in the fair value zone. Hence, we continue to remain neutral on the equities while remaining overweight in mid and small cap. Over the past year, markets have undergone a grinding time correction, leading to muted portfolio returns and visible global underperformance. Pressure has been most pronounced in small caps, where many former leaders have corrected 30 to 40% from their peaks, testing investor patience. This phase is driven primarily by flows and supply, rather than any broad-based deterioration in underlying economic or corporate fundamentals. FIIs have been largely on the selling side, while muted FDI and a heavy IPO or QIP pipeline have absorbed strong domestic mutual fund inflows. Elevated valuations are the common driver of foreign profit-taking and aggressive primary issuance. On the other hand, fundamentals remain resilient, earnings growth has started recovering, corporate leverage is low, and bank balance sheets are also quite healthy. Macro indicators are supportive, with inflation contained, GDP growth outpacing peers, oil near USD 60 to 65, and CAD around 1.3 to 1.4%. The government and the RBI have also taken many growth-oriented measures. The last quarter earnings season provided a positive picture with reduced intensity of earnings cuts. The trailing valuations across the broader market have moderated compared to 1 year back, and froth has also subsided. We believe that the current phase is primarily a flow and valuation correction, not a collapse in fundamentals. Positives outweigh the negatives, making the equity outlook constructive. Equity view, neutral. Portfolio allocation, 50% allocation to large caps, 10% to global and 40%, 5% overweight, allocation to mid and small caps. Investment strategy, lump sum investments in hybrid funds at current levels. For pure equity-oriented strategies, a staggered SIP or STP approach over the next 3 months is prudent given elevated valuations and higher volatility. Any sharp correction should be used for aggressive deployment. In fixed income, as discussed, monetary policy has turned supportive. With the financial year 2026 CPI projected near 2%, the RBI cut the repo rate by 25 bps to 5.25% in December while maintaining a data-dependent stance. The spread between the repo rate and 10-year GSEC yields has widened, implying an above-average term premium. The yield curve has steepened, with short-end yields easing post-policy while long-end, 10 to 30-year, remaining elevated, creating a bit favorable setup for selective tactical duration exposure. We continue to favor accrual strategies across the credit spectrum, along with income-generating real assets like infrastructure investment trusts for the core allocation. From a commodities perspective, gold is maintained at a neutral stance within asset allocation. While global uncertainty and central bank actions provide some support, the absence of acute macro stress, moderation in the buying by central banks and recent rise in prices limit the case for aggressive positioning.